This conference
Oh,
will now be recorded.
okay, everybody. Welcome back. This is our semi-annual. We do it twice a year. Our investment club video, where we're going to talk about the markets, what to expect, what are we talking about, like what do we expect for the markets moving forward. So, I'm going to go over a couple of charts. Again, this is not a trading club. I know we do trading on our other groups, but this one is strictly long term. So, first thing I want to do is kind of go over my portfolio. And if you have any questions on this portfolio, I always send it out. You let me know. So out of all these names, I don't want to sell anything. I love exactly where I'm at. I'm going to go over each one again and why I like them, just to kind of go over it. But if you feel free any questions, just interrupt me. Go ahead. Apple, one of our top 10 names of 2020. I sent you guys that information already. If you guys are making a lot of noise, just press mute for me if you don't mind. If you have a question, just unmute. Thank you. All right, so Apple. Apple is one of our top 10 names for 2020. Apple, we know in regards to, we kind of know the drill with Apple. Tons of cash, still growing, best performer in the Dow. Their AirPods alone, if they were just a company in sales, would be in the Fortune 500. That says a lot about their brand. To me, Apple is in the forefront. It's also a play on 5G. We have a super cycle in 2020. So be ready for that in September with the new iPhones rolling out. I personally am a big Apple head. I have everything in my house that is Apple. If Apple sold a car, I'd probably buy it because that's just me. That kind of Apple degenerate. But again, I've always said, if there's something that you like, a brand that you really like, that you follow, that you tend to collect or whatever, if you're really into them, feel free to invest in them. It's best to invest in something that you know. So a company that you trust or something that you know. If you like a lot of Starbucks coffee, Starbucks would probably be a great stock for you, for example. But for me, Apple, I own a MacBook, I own an iPad, I own two iPhones, an iMac, Apple TV. I don't have the watch, but I have the new AirPods on and I love them. So Apple is not going to go anywhere. I'm going to go into more detail in the top 10 podcast, which I'll send to you guys. But Apple, again, like I've said, don't trade it, just own it. You just want to accumulate shares of those because they keep buying back stock. That lowers the supply of Apple shares outstanding. Now, I highly doubt you're going to be to the point where you're buying so many Apple shares, you're not going to have enough unless you're worth billions. But even Warren Buffett has that issue, doesn't have that issue. So keep that in mind. Microsoft, again, I own Microsoft, love Microsoft, the cloud. The companies run perfectly, AAA rating in their debt, tons of cash in their balance sheet. They're run correctly. Their last real acquisition was LinkedIn, and last big acquisition. I think they also had some kind of messaging service that competes with Zoom, and I forget the name with Microsoft, but Microsoft owns LinkedIn now. Obviously, Xbox is still growing, not as big as Sony PlayStation, but Microsoft with the cloud, they just won the Pentagon contract. They took it right from Amazon. As you know, Amazon CEO is Jeff Bezos, who's not, who owns the Washington Post, and Donald Trump is not a fan of Jeff Bezos, as we know. So that's a win for Microsoft. And again, I think it's a fortress balance sheet. They got everything going well. It's a well-managed company. Satya Nadella is amazing. I still see him growing and breaking all-time highs, continuing. SPY-G, again, I know I always say you guys SPY-G, all about the S&P, all about the S&P. Yes, keep it simple. I don't have 25,000 in S&P. I will get there, but I have not done that yet because my biggest position is Verizon. And I'd rather own Verizon for the dividend than SPY-G for the growth, personally. So I own my majority share in Verizon. As you know, that's another portfolio. I want to accumulate Verizon also for a 5G play. But SPYG, pretty cheap, about $42 a share. Price wise, in a sense, not PE ratio size, but like, if you have $1,000, you can acquire a nice amount of shares, probably about 30 shares of SPYG. Its growth as the big companies. If you want to kind of go over with me, we can. Let me go over that with you. I could just go to SPYG Holdings here on Google. Google is your friend, as always. Let's type in SPY-G ETF, and we can actually see exactly what is in SPY-G. And if you own this index, this is what you'll own. If I can bring it up here, it owns 8% of Apple. 8% of the ETF is Apple. Owns Microsoft, Amazon, Facebook, Alphabet, Visa, MasterCard, JP Morgan, and Procter & Gamble. These are names that are not going to go anywhere, guys. Very low expense ratio. We're not paying a mutual fund manager to run it. It's just an ETF. That's exactly where I want to be. And you can see the growth. SPY-G in 1 month, 5%. Rolling 3 months, 13%. 1.41% year to date. This is so far. In 1 year, 33%. I like to see this consistent gains, 14, 13. I want my investments to be very boring. You know me. I want a long term, and I love SPY-G. I may add to that, but when I do, I'll definitely let you know. UNH. UNH is a name that I didn't put in the top 10, but it was last year, and they did great. I want to talk about healthcare with you guys as well. It's an election play. So we know that presidential elections in 2020. I talked to the traders on the last call, and we talked about the election. And in my opinion, this is just my prediction that Donald Trump will win re-election, regardless of your political affiliation. As long as the stock market's going up, economy is strong, and employment's down, we're going to be fine, regardless if we have a war with Iran, which I doubt. But that's a good thing for healthcare companies and defense companies. UNH will be the biggest beneficiary as long as there's no Warren administration or a Bernie Sanders administration who wants to have healthcare for all. That is not going to happen in the United States, regardless of your political affiliation. This is just the reality. UNH will be a big beneficiary of those two being out of the Democratic race, since Joe Biden, who might win, is more of a moderate. So UNH will be a big beneficiary. I see them continuing to go up. I like United Health. It's the only healthcare name that I own and I actually like. McDonald's, what can we say about McDonald's? We love them. I think with technology, with the mobile app and Uber Eats, I think that they're still growing. They pay a great dividend. I still like their growth in regards to the fast food names. Franchising has done wonders for McDonald's. I think they continue to go up. We got into them with the top 10 of 2019. We did great. And I like McDonald's long-term, great management. The best thing they have done, in my opinion, is the breakfast, all-day breakfast, which has done amazing work for them. Margins are up, growth is up. The only thing that we're waiting on for McDonald's is to compete with a Burger King and the Impossible Whopper. I think McDonald's should be on the cusp of this year going into the more of the vegan side. Just keep in mind this vegan option stuff. I think it's going to kind of go away once we have a recession, because going vegan is a little more expensive than mass-produced beef. You know, farmers and beef producers and corn producers, they are also what's the word I'm looking for? They are also helped by the government. I hate to say the word help, but they're helped by the government, and they're given bailouts when needed, the farmers. So again, it is cheaper to make the food McDonald's makes with their beef. Whether it's real beef or not, that's another question. But genetically modified food, GMOs, that's all government helped and government sponsored. So it's cheaper to do that than to go vegan. So I think McDonald's will go vegan this year, in my opinion. I think that gives us another bump up with the shares, and I want to own it. I wouldn't be surprised if we hit $240 a share easily by this year. And I like it. I still own it, and I don't plan to sell it. Roku, one of our top 10 of 2020. Roku has been a darling to trade when we get it right. But Roku has something that these streaming services don't, like a Disney, like Apple does, like Netflix does, or HBO, or what have you. They don't have to pay for streaming content. All they are is a player that provides the streaming. So I think with Roku, this is their number one in market share in regards to the streaming service, meaning that they're the one to actually have the ability to have multiple streaming options all embedded. Like Roku with the Roku player is the fact that they can grow without any kind of content issues. So they don't have to pay billions like a Netflix for this content and go into debt for it. I like Roku because they're more of the engine, the vehicle that provides the actual streaming to you. So the only thing that could hurt Roku is if more people tend to stream on their phones, because then you don't need Roku for that. I would expect more televisions. As you know, TVs are getting cheaper now because they're more mass produced. And the bigger the TVs and what have you, more definition, 4K, whatever, I think more TVs now are going to be embedded with a Roku streamer without buying an extra set-top box is going to make a difference. And I'm waiting for that with Roku, that they'll embed cable, maybe like Comcast or DirecTV embedded with Roku. That could be a play. There's not a rumor on that being set up yet or anything like that, but that could happen in the near term or longer term, 24 months, where it just becomes the one-stop shop. I would say Roku could probably be like your modem or your router. Every home will have one. and that'd be the best way to actually watch all your streaming content. You can watch. I know there's Sling TV, Slingbox. There's also YouTube TV, but Roku offers all that to watch. AT&T, one of our top 10 of 2020. It's a 5G play. I think they've bounced back on their balance sheet with DirecTV, that acquisition. They were burning some cash, but I think they're actually getting their books in order. Their return on equity is very strong. Great. They actually beat the S&P last year. They have a really great dividend. As you know, I've been saying AT&T's dividend, I love it, and I own it, and I don't plan to sell it. And I think with the 5G rollout, with the Apple super cycle, it's going to boost AT&T, since AT&T, I believe, is the largest provider in the United States. The DirecTV thing, them owning Time Warner and stuff like that, yes, it kind of brings a little bit down in regards to return on equity and cash. Could be a little bit of a cash burn, but they do own a lot of content, so they could push a DirecTV Now service, which kind of gives them more of a revenue stream. Louis Vuitton, Moet Hennessy, the billionaire guy that owns it, Louis Vuitton, Vernal from France. He's done an amazing job with the market being where it's at. A lot more millionaires now being minted, billionaires being minted. People still shopping for high-end fashion. Them buying Tiffany's is a great step forward. I think LVMH is already consolidating all the big brands. I don't think they're going to buy a Gucci or anything, but the more cash they have on hand, the more they can bully the high-end retail market. And as long as they're making money and you're bullish on the stock market, people feel richer when the market goes up. They're going to buy some more purses and handbags and liquor, high-end liquor. So that's what I like. Nike, another one of the top 10 of 2020. What can I say? I do love Nike. Even after the Colin Kaepernick controversy, they bounced back. Even with the issues with China, they had a great earnings call. They gapped up very nicely. I still think their margins are pretty great. It could be a little overvalued in regards to PE, but it's a brand that's not going to go away. Their Jordan brand actually hit $1 billion recently for the year, which is great. Basketball is still growing worldwide. They have really great partnerships, and I'd rather be direct with the factory in Nike than own any kind of retail name like a Foot Locker or Dick's Sporting Goods, for example. I think Nike with their app has done great with technology. It's actually helped people who want to collect sneakers have access to them. For example, I bought some Jordan 12, I think it was Jordan 11s on the app, and it was very easy. Didn't have to wait in line, just bought it on the app. Very simple, bought it with Apple Pay. So of course I did, Apple Pay, right? And Nike is a great company I want to own long-term. Phil Knight did a great job building the company, and I think moving forward, they're going to continue to grow. Right now, they're at about $101 a share, almost 102, and I think we should target around 130. It shouldn't be an explosive stock, but again, due to PE and valuations, but I think it's a great one to buy. Ulta Beauty, I own as well. The Instagram world that we live in of all looking the best, makeup artists and what have you, that's the way to go. And I think Ulta is a great play on, the selfie market, I call it. Jim Cramer talked about it. The selfie market, the Instagram market, the experience market. Women want to look their best. Ulta is probably the most value brand out there. The only other one that may compete will be Sephora, which is owned by LVMH, which we own. And, you have both of that there. I think makeup is not going to go away in a recession. Women still want to look their best. Why not own a piece of it? Home Depot, we love Home Depot, especially when there's a hurricane season. Home Depot tends to spike just like Lowe's, but Home Depot has a great retail footprint. It's Amazon proof. You're not going to buy your lumber on Amazon. You're probably not going to buy tons of power tools on Amazon. You probably like to go to Home Depot and get the stuff yourself. Home Depot, I would like to kind of push more the technology side in a sense. I think they're still in that adoption phase of an app and, kind of pick up at the store like a Walmart does. But, for contractors and expanding housing and a bull market, Home Depot is the way to go. Lyft and Uber, I own both. Again, it's a longer term play. It's something that we're really expecting ride sharing to grow. I actually saw an interesting chart on Bloomberg that was talking about how people are driving less and less now more than ever. So Uber and Lyft, the one thing I do like about them is entering the food delivery service, which is great, but they're not making a lot of money yet. But keep in mind, guys, Amazon was in the same place around the 2000s. They weren't profitable for a while. I think Uber and Lyft have a niche market where the ride sharing is the future. And I think the next step forward is autonomous vehicles. If once that gets off the ground, autonomous vehicles, if you're very bullish on autonomous vehicles, you definitely want to be into Tesla. You definitely want to be into Uber and Lyft, and also AMD, NVIDIA, and Micron. Those are the chips that are going to be made to actually move that forward, the autonomous driving, where, you know, just the car picks you up, you don't have to talk to anybody, and they take you where you want to go. That's the way to do it. Grayscale Bitcoin Trust, as you know, I'm bullish Bitcoin. It has been the best asset class, outperforming across the board. I want to own it. I'm going to own it. I own 100 shares, and I don't plan on selling. And Disney, of course, we love Disney. Disney Plus, they're the king of the box office. Star Wars, Marvel, they're going to keep pumping out content. They own the content, which is what I really like with Disney Plus. They don't have to pay like a Netflix for other content. They just own it. They just have to produce it themselves. Netflix does own some of their content, like a House of Cards and some other stuff, like a Peaky Blinders. But I think Disney can actually, in a sense, leverage their current portfolio of animation and these big names that people follow, Star Wars, Marvel, Pixar, and continue that moving forward, where Disney Plus may even have sequels on there. So they have both vehicles, the actual box office to drive in traffic there, obviously, and of course the Disney Plus app. What I've noticed too, and I've heard, is that now they're kind of rotating what's available. Not everything will be available on Disney Plus. That's kind of maybe kind of pull some subscribers away. For example, like The Mandalorian just finished, so some people maybe want to get away from Disney Plus, but Mandalorian is a great way to set the flag bearer for a Disney Plus moving forward. If they can produce more of that kind of content and get people to flock, that's great. And then remember, they just started. I think they're going to continue to grow. Their portfolio is very strong, and they just bought some more land in Orlando. I'm hoping, cross my fingers, that we can get some kind of Marvel park set up. They actually have to make a deal with Universal Studios, which is in Orlando as well, who owns some Marvel Marvel rights in their park, which is called Islands of Adventure, before Disney bought Marvel properties. If they can kind of pull that off and maybe make some kind of park with Marvel, then Disney right now is very cheap. Disney would probably be at $200 a share if they can get that done. Now, will it get done? That remains to be seen, but we'll see what we get. So that's my portfolio now. The top 10 stocks, we've talked about it. Well, we rarely talked about it, but let's kind of go over it together. I'm going to have the podcast on it, of course. We talked about Nike, we talked about Disney. L3Harris, I'm pretty sure you're probably thinking to yourself, what the hell is that? Well, L3Harris is a company, Technologies is a defense contractor. And I like L3Harris a lot because they're cheaper than a Boeing and they're cheaper than a Lockheed Martin. So I want to own that longer term. So let me go ahead and see if I can get here. Let's see, LHT, let's see, L3. Let's see, I think I have the ticker here. Let me see, LHX, sorry. Yeah, LHX here. Oh, I just logged out. All right, let me go ahead and log in for a second. Give me 1 second, fellas. Let me just log in and we could talk about it here. LHX. All right, perfect. LHX, now we're above here. So LHX, defensive company. Let's kind of go over a little bit what they do. Since everyone's probably having questions on what the heck this company is. I haven't really talked about it before, but I did some research on it and I do like it. It's a technology company that provides product systems and services that have civil and defense applications. The big thing here is that they have space and intelligence systems. And what is a new branch of government that Trump just created? Space Force. So this is very bullish on a re-election with Trump being Space Force, and also defense with Trump being reelected. So we are bullish on him being reelected and continuing this kind of push to more of defense money into the Pentagon. And I think L3Harris will be a very big beneficiary of it. So let's kind of go over a little bit what they do. What they return. EPS growth is very solid, 10%, revenue up 6%, and 10% on the dividend. So they do pay a dividend, which is what I like. So comparison here, 1.43 in yield for LHX, 26% PE ratio is right in line with a market multiple of the S&P, which is right around, I thought I had it here, 24. So, you know, if you're paying a standard multiple for a growth company, it should be around 35, 32. So L3 is pretty cheap. So I do like that. If you want to compare to a Boeing, Boeing is paying, it's 51 PE, so it's expensive. They pay a higher dividend, but we know the drill with the 737 MAX, they're a headline risk. So I'd rather not be there. And if you look at it, Lockheed Martin pays a nice dividend. Their PE ratio is a little less. They are up a little bit, but look at the stock price too. It's $4.13. So let's look at the earnings. See if I can bring up the fundamentals. Strong EPS, revenue, and dividend. But I think in regards to the space to me is the key. I think that as we get more of a push from the Pentagon and the White House into space, I want to be in L3 longer term. Lockheed Martin is fine as well. I'm not against Lockheed Martin. I think they're a great company too, but I still like LHX. Sorry, I'm still memorizing the ticker. LHX has a little more upside in my opinion. They actually outperformed Lockheed Martin last year. And if you look at a 3-year period, they're up about 105%, and against the S&P, which is up 41. So those are the names I've been watching, and the rest we've talked about. All right, any questions, guys? Feel free to press unmute and ask away. I know we went through a lot, so feel free to ask.
It's Anel.
Hey, Nell, what's up?
Hey, so my question to you is, where do you see the streaming wars going in 2020? Do you see any new players or any existing that might knock it out of the park as we move along here?
Streaming plays, obviously, I think Disney Plus has the higher upside because they just started. I think Netflix is still strong, but the only thing I don't like about Netflix is their cash burn. So that's kind of going to hurt them. They have to provide more bonds in order to pay for their streaming service. I think that Netflix is going to increase their streaming prices. The one thing that Netflix has going for them is the international market. India has done very well. I don't think Disney Plus has even scratched the surface on international. Disney has a higher brand reach than a Netflix. So I think Disney on the top, it should be the #1 for streaming. #2 would probably be Netflix, obviously. And #3, probably right in the middle, like HBO and Cinemax and those guys. Maybe like, was it YouTube? Is it YouTube TV? Sorry, YouTube TV, is that what it's called? YouTube TV? But I would think Disney Plus is on the cusp. I don't think there's going to be another service that may be coming out that I know of. The one thing I have been interested in is what are the movie theaters going to do? You know, less people going to go to the movie theaters because they have their Netflix at home and they're streaming? Maybe they're going to be a service where they can actually, the movie theaters can actually stream the new movies to a box, like a Roku box. Could it happen? Probably not immediately, but I think that's something that's to consider because streaming is the future, and I still think Disney Plus is going to lead the way in regards to content. But Netflix is still formidable, but it's very expensive in regards to PE since they're a very growing company, and they were the best performer for the decade in the 2000s to 2009, 2010, 2019. But good question, yeah. Anyone else out there?
I actually have a few questions if nobody else is going to
Yeah,
ask.
please. Yeah, no one's there to ask. I mean, go ahead. Maybe you ask a question that no one else wants to ask, or maybe they didn't think of. Go ahead.
Sure. So I recall last year, Fundrise was brought up, and I think you have a small investment in Fundrise, and I just wanted to check on your feedback now that it's been some time. In addition to that, I also wanted to ask about where you foresee the future of pot stocks and crypto in 2020.
Okay, Fundrise, they just updated something with me. I'll read it to you because this is in my personal email. It says, beginning January 1st, 2020, all redemption requests submitted for e-REIT investments we process on a quarterly basis as opposed to a monthly basis after a 60-day waiting period. So they're making it less liquid and accessible for money if you want to withdraw. So you can still withdraw from Fundrise, but again, it's every quarter on a quarterly basis. So you're going to have to keep that in mind. The new policy is like, if you have a request submitted February 15th, it'll be processed on April 1, and then you'll get your distribution 3 to 5 days later. So Fundrise is investment in real estate. It's kind of like buying a property. You're kind of crowd sharing that. I still own it. The return is not amazing, obviously, not like stocks, but again, it's a good way to diversify the portfolio that you want to have. I don't own any rental properties at the moment, So it's a good way to kind of dip your toe in and put a little bit in. I put in, I actually paused my auto pay on Fundrise. I'll restart it in March because I put some more into stocks than anything else and more of into the company. But Fundrise, keep in mind, if you put money in Fundrise, you're more than likely not going to pull your money out. So don't put money in that you need immediately. We've always talked about this. Money you need immediately, you need to put in a savings account or in a bond fund, for example, not stocks or investments. Investments money you don't see yourself using for at least 24 months, I would say. That should be the rule of thumb. But I still like Fundrise. I haven't had an issue with them, and I'm sticking with them. In regards to pot stocks, we just had a couple of states legalize. Remember, these pot stocks are based in Canada. And I still think that right now, if you are a long-term investor, pot stocks are still fine to get into. I sold my CGC before we had the huge fall. Remember that? But again, I still like the company. I just don't own it. If I do buy some, I do want to see a little lower on the downside to get some on the cheap. CGC, if I bring up the chart, I know it was on a stock trading call, but CGC, let's go ahead and bring up a longer term chart. The 3-week period. You can see the high of 59.25. We're at 19.90. If we can kind of get into below 10, I'd probably buy some hand over fist because this will give an opportunity to get some really, really cheap. This is on a weekly chart. You can see in the bottom left. I think that once we get below sub 10, I want to get back into CGC. That's the only one I do like is CGC Canopy Growth because they have the backing. Constellation Brands, they swapped out the CEO. Again, these are the times that, you know, when things are really cheap, you want to get in, you know, especially if you're a long term. Marijuana is going to get legalized. It's just a matter federally. It's just a matter of when. It's just tough when you have a Republican administration. So again, if you think Republicans are going to be in power for the next 10 years, okay, maybe weed stocks are not for you. But again, if you think that the times are changing and marijuana will be decriminalized federally down the line, then you definitely want to get into pot stocks and you want to hold that. You definitely want to be patient on it. You're not going to get immediate gratification on it, guys. I'm sorry. That's why we didn't put in the top 10. That was one of our losers of the top 10 last year was CGC. We were up for a little bit, but you know, so what can you do? And with regards to crypto, right now, crypto, you just want to accumulate Bitcoin. That's the only thing you want to accumulate, in my opinion. I own Bitcoin. I don't plan on selling it. I still think we still have a lot more to go. It's still the best return on investment out there, best returning asset. It's still outperformed the S&P, and we're at now. We're at Bitcoin at 75.05. Are we going to hit 19,000 this year? No, I don't think we'll hit 19,000. Are we going to break 12,000? I do believe we break 12,000 this year, in my opinion. I think 12,000 is the level that we break on Bitcoin this year, and I think that more weak hands get shaken out, then we'll get to the upside, continue up, and you know, in 5 years, will we hit 25,000? I believe so. That's why I own it, and I still like Bitcoin. I don't like seeing the word crypto because the only one I like is Bitcoin. Just a heads up. Anyone else out there? Any other questions?
I have another.
Yeah, go ahead. You got it. Yeah, no problem. If you want to be the only one asking, that's fine.
Do you think that we'll see as many failed IPOs in 2020? And are there any IPOs to kind of watch for in 2020?
The only IPO I'm really looking forward to getting, and I'm probably going to get in when it opens this year, will be Airbnb. That's the one I really want to get into. Now, especially with what happened with Uber and Lyft and everything, I think the IPO market may cool off this year, especially with the WeWork nonsense that happened. So we'll get a cool off, but I think Airbnb is the one to look for, and that's the one I'm going to buy. And I will let you know when I buy for sure. But I remember I bought Lyft the day of the IPO, and you know, I bought it for like 76 bucks, and I know I lost some money, but I haven't closed it, so I technically haven't lost anything. But I plan to hold it anyway, so it really doesn't matter to me. But yeah, I still think that the IPO market will cool off and compared to last year because of that WeWork debacle. And I think Airbnb is the only one I see that I want to get into. So yeah. Pietro asked, no bank or financial institution in your portfolio? Nope. Actually, I do. It's in my SPY-G, JPM, but no, I don't own any banks, personally.
What about any potential stock splits in 2020?
The only potential stock split potential that may come is probably Apple, probably. And it's been years since they did it, but
Well,
I very, very low. The one I keep clamoring for is Amazon, and I don't think it's going to happen. But I think Apple will probably be the one that could do it. I mean, they really need to hit. The last time they did it was at $600 this year. We're right around 300. We would need a big run up to 400 or 500, which would be great for us as shareholders. But I still think that Apple will probably, they're more shareholder friendly than Amazon is. So the companies that do a lot of buybacks, those are kind of the keys. Those are the ones that will give you the hints that they're more likely to do a stock split than an Amazon who don't give a crap about investors. They don't care, which I hate, but whatever.
so there's really
That's the
no
only one I could think of.
to
No,
stock.
what?
There's really no hard and fast rule to a stock split. Like
No,
something.
you don't have to do it. I mean, there is no rule saying you have to do a stock split. For example, Berkshire Hathaway has never done a stock split. That's why that stock is worth 100 grand. But they have a Class B shares that you can buy, and that's a little cheaper. I'll show you right here. Berkshire Hathaway. You can see Class A, 339,000 a share. Never had a stock split. Well, you can buy Class B shares. See if I can get that going. Class B shares, and they're 228. I don't see Apple ever doing a Class B shares, obviously, or anything like that. But I mean, it's really up to the discretion of the board of directors. And more times than not, they don't really look out for retail investors. They don't care. You know, as long as they're making money, they don't care. Unless they really want to attract new buyers. The last big stock split was Apple, obviously. The other one was a reverse split by Citigroup because they were in the single digits. So they did a reverse split in order to make sure that mutual funds, by rule, mutual funds can't have sub $5 companies in their portfolios. And Citibank was a big part of it. So they had to do a reverse split in order to show that, hey, they're not a penny stock anymore. So, but Citigroup bounced back very nicely since the 2008 financial crisis. But there is no rule that they have to do any kind of stock split, unfortunately.
Thank you.
You're welcome. You're welcome. Anyone else? Anyone else? Pretty quiet. And of course, if you have any questions, feel free to ask me on the chat, as always. But yeah, I mean, of course, anytime we buy some stocks, we will let you know, as always, when I buy them and the price I get into them. Again, don't buy everything in one block, guys. Here's another tip. When you buy stocks, make sure to buy them in blocks. If you want to buy, for example, $2,000 worth of stocks, I'd say 1,000 just to make it easy. $1,000 of stocks, and each stock is worth $100 each share, whatever. Don't buy 10 shares right away. I would buy four, then two, so you can average out a good price. Don't buy it all in one shot. You want to average out a good price. Just keep that in mind. Now, if you're just gonna buy one share of like a Tesla because it's expensive, that's fine. You can just buy one. But if you're gonna buy, 10 or more shares, kind of break it up into blocks to make life easier, so you can average a good price. Anyone else out there? Questions?
I have another question. Let's
Shoot.
let's just say you have an extra $10,000 laying around.
Mm-hmm.
Could you split that out between like AT&T, Apple, Microsoft, split it all up, or just dump 10,000 in SpyG?
My assumption is your portfolio already has some of these names.
Yeah.
If you had 10,000 right now, I'm gonna be completely honest. I would say break 5,000 into Apple and Microsoft, and then put the 5 into SpyG. I just think those two are better to put in. I hate to put the ranks of the top 10 like, oh, what's better than the other? They're all great in my opinion. But I think Apple is in a league of its own. I think Microsoft's in a league of its own. And those are the names that I still like, and they're going to continue growing. Are we going to, listen, just heads up. Stocks don't go straight up. We know this. you're gonna get some pullback. I wouldn't be surprised if Apple dumps a little bit to maybe 250 a share. Okay, if we get like a bad earnings report or some kind of bad news, 250, 260, guess what I'm doing there? I'm buying. I'm gonna buy. So I'm waiting for a little bit of a pullback, a 10% pullback on Apple. I'll probably get some in. So just keep that in mind. Again, pullbacks are your friend, especially when you're a long-term investor. So when you're looking at the stock market, you're not trading it, you're just investing, and you see a big dump for whatever reason, an Apple or these big names, that's your opportunity, the Black Friday shopper, and start accumulating these names. Start picking up some, start nibbling here and there. I want to buy them cheap. I don't want to buy them, just because they're up. Obviously when we have the top 10, that's different. We're looking long-term. It doesn't mean buy everything right now. I'm just saying that's our picks. These are the ones that we like for 2020. And of course, we have a lot of opportunity in 2020 with the elections, with earnings reports, with this Iran stuff, with the Fed. I mean, there's just so much opportunity. 2020 is definitely an investor and trader's paradise because we have a lot of opportunities. And now we have so much information so accessible with the internet. It makes life so much easier. I hope that helps.
Yeah, it does.
Great. Okay, so if we're not gonna have any more questions, I guess we'll end the call there. I'll send you your guys this copy of the video so you can keep and watch whenever you want, and we'll leave it there, guys. I hope this really helped. You didn't get a lot of questions, but I'm pretty sure you guys are just taking notes, or you're just shy. I know not shy. I know that.
I do have one more question.
Yes, please. Go for it. Go for what you got.
So let's just say, obviously, I understand you're bullish on a Trump re-election, but let's just say we get a surprise, right? And Sam, we got a Democratic in the House. And, how do you foresee things changing at that point for long term for the investors?
If we did get a Democratic, now it depends because you have two sides of Democrats. You have extreme far left, or you have a little more moderate. So give me an example. If you're saying if Bernie wins, is that what you're saying, or Sanders or Elizabeth Warren wins, or are you saying if Biden wins or Bloomberg wins?
Let's just say Bloomberg.
I'm sorry?
Let's just say Bloomberg.
If Bloomberg wins, that's very bullish for the markets. Right off the rip, that's great. So I'm not changing a thing. If anything, I'd probably buy some more. Of course, I'd be like very bullish on the market because he's very market friendly. The guy ain't dumb. He know how he makes his money. If Biden wins, that'll be very good for marijuana companies, in my opinion. I think that'll be bullish for that because Democrats tend to be a lot more liberal, as we know, in regards to civil liberties and locking people up for marijuana. They're very pro marijuana. So I like that. I like that a lot. The only thing it may hurt is oil fracking and environmentalists. So I'd be a lot more, bearish on oil for sure. A little more bearish on defense contractors. Yes, may hurt, some defense names because Democrats tend to not go into war. That may not be true, but that's from the optics of it. But let's say if we get that surprise, if Bernie Sanders wins, okay, it's gonna be pretty bad. I mean, the markets will take a big hit because he's very anti-Wall Street. Elizabeth Warren, same thing, but highly doubtful they'll win. But I said the same thing about Trump, and Trump won. So again, I've been wrong before. I thought Trump didn't have a shot, and he won. Again, I have been wrong before. Whatever happens, we're gonna react. Let me make this clear. Regardless who's in power, whoever wins the presidency, the world's not going to end. We've seen the worst in 2008. That was literally the brink and the end of capitalism in a sense. We had every opportunity the capitalism to end, and we got bailed out. So I think we get a big reaction, sure, but will I change my investment profile moving forward? No, because even Obama, who was pretty liberal, we were fine. We actually grew. The stock market grew more under Obama than any other president since Reagan, I believe. So, it's still the country. They're not a king. The president is just one branch of government. It's not all branches. So, and for Trump to lose, I think we would need a pretty big downfall in the economy, which I don't see happening. Okay, so here we go. Do you think BlackBerry can come back? No, Pietro, I don't think BlackBerry can come back. I'd rather just be an Apple. Thoughts on Oxy? I've never heard of Oxy. I didn't want to say it's Oxy Petroleum. Is that what it means? Oh, Oxy Petroleum. I don't own the stock. I'm not really bullish on oil. The only thing is because of fracking. I think it's just up because of the tensions with Iran, but I'm not very bullish on oil, to be completely honest with you. And Oxy's in the year chart is pretty low. You saw I don't have much energy. I don't have any energy companies on the top 10. And for the reason is that most energy companies have a lot of debt and they have to pay back their debt with high dividends and their bonds and what have you. And these energy companies are very highly levered. So a lot of them fail. I'm not saying Oxy will fail, but if you really want to be in energy, the only names I really like, again, I've said earlier too, ExxonMobil and Chevron, because they have a balance sheet to back up their dividends and to back up their companies. And they don't need to take on more debt for their drillers or their refiners. I like the big names. I don't like the smaller names, just a heads up. All right, anyone else? Okay, guys, I guess we'll end it there. Any other questions, feel free to DM me on the chat or just hit me up on the chat and we'll go over it wherever you need. If you need a little more help personally, feel free to DM me. If you have any personal questions that are about your portfolio or you just want to send me a screenshot of your portfolio, that's fine. Let me know. Don't put it on the chat if you don't want your information out there. Just DM me personally, guys. All right. Have a great one. Enjoy. And, cheers to the gains. We're going to have a great 2020 no matter what happens. And let's crush it, guys. All right. I'm glad that you're part of the investment club and I'm glad that you're with us and more great things to come. Have a good night, guys.